A locksmith who sees 3 customers per week can out-earn a cafe owner serving 300. That dusty carpet store on Main Street that's been empty since 1987 might be more profitable than the packed Chipotle next door. Today, I'll explain empty storefronts and cash businesses like you're 5 years old. By the end, you'll understand why customer traffic means almost nothing for profit, why money laundering through fake retail is nearly impossible now, and why most suspicious-looking shops are completely legitimate. Let's start with what people assume when they see an empty store. They think drugs, they think mafia, they think Breaking Bad and car washes. But here's the truth most people miss. Customer traffic and profitability have almost no relationship. A busy Starbucks might make less profit per square foot than a sleepy locksmith who owns his building outright. The locksmith doesn't need foot traffic. He needs 3 commercial clients and 12 emergency calls per month. That's enough to cover his life. You'd never see those transactions because they're scheduled, wholesale, or done at the customer's location. The money is invisible from the street. This is what people actually mean when they say cash business, even though the term gets twisted. A true cash-intensive business handles fewer transactions but bigger ones. It operates with tiny overhead. It serves customers you can't see from the street. Think about a wholesale florist. They're not selling 1 rose to you on Valentine's Day. They're selling 500 roses to 3 restaurants and 2 wedding planners every week. Their shop looks dead because regular people aren't the customers. The real money flows through invoices, delivery trucks, and long-term contracts. No cash register needed. Now, let's talk about why the money laundering theory almost never holds up anymore. People imagine someone walking into a nail salon with duffel bags of cash. They ring up fake customers. Boom, clean money. But that's not how modern banking works. Any cash deposit over $10,000 gets reported to the federal government automatically. Your bank has no choice. It's called a currency transaction report, and it's the law. Try to dodge it by depositing $9,000 at a time? That's called structuring. Banks are trained to spot it. They'll file a suspicious activity report anyway. Now you're on a list. Here's what matters. The IRS doesn't just look at how much cash you deposit. They compare it to what your business type normally does. Pizza shop depositing $60,000 in cash monthly? That might be normal. Pizza shops handle cash. But a high-end furniture store suddenly depositing $40,000 in cash weekly? Red flag. Furniture stores don't work that way. People finance couches. They use credit cards. They write checks. Cash doesn't fit the pattern. Pattern breaks get attention fast. The government has decades of data on what normal looks like for every industry. Your fake revenue has to match industry averages perfectly, or auditors will notice within months. So why do people still think it's easy? Because TV makes it look simple. But in real life, laundering money requires more than fake receipts. You need to pay taxes on that fake income. You need to explain where your personal spending comes from. You need employees who'll lie on record. You need vendors who'll create fake invoices. You need accountants who'll risk federal prison. You need years of consistent fake revenue that survives audits. It's so risky and expensive that actual criminals mostly avoid it. They use crypto instead, offshore accounts, real estate, shell companies, trade-based schemes. The nail salon thing is a relic from the 80s. Here's a pattern that matters. Businesses that actually get caught for laundering don't look empty. They look too successful. They show profit margins that are mathematically impossible for their industry. They have revenue that doesn't match their inventory purchases. They operate in high-volume, low-verification industries where fake transactions hide easily. Empty stores are terrible for laundering because they attract attention. Successful-looking stores blend in perfectly. Now let's get back to those empty storefronts and why they survive legally. Some businesses own their buildings outright. No rent means you only need enough income to cover utilities, insurance, property taxes, and your salary. A locksmith who paid off his mortgage in 1995 can live comfortably on $70,000 a year. That's 3 jobs per week. You'll never see him busy, but he's doing fine. His expenses are so low that competition can't touch him. New locksmiths pay $12,000 monthly in rent. He pays $0. That's a $144,000 annual advantage before he picks up a single wrench. Other businesses have old leases locked in at rates so low, they're basically free. A pizza place paying $2,000 monthly when current market rate is $12,000 has massive breathing room. They don't need the same revenue as new competitors to survive. They can charge less, work fewer hours, and still profit. That empty dining room isn't failure. It's efficiency meeting favorable economics. Then there's businesses with invisible income streams. That weird import store selling random furniture, they might do 90% of revenue online. Interior designers order custom pieces through them. The storefront is just a showroom and warehouse. Nobody walks in because nobody's supposed to. The antique shop that looks closed half the time? The owner might make 6 figures yearly buying estate collections and flipping them at auctions. The shop is just where they sort inventory. Same deal with liquidation stores, wholesale outlets, and places selling to other businesses instead of the public. But here's where it gets interesting. Some businesses actually are barely surviving, but they stay open anyway. The owner has another income source. Maybe they're retired with a pension, and the shop is a hobby that breaks even. Maybe their spouse has a high-paying job, and the business is a passion project. Maybe they inherited the building and literally have no overhead except time. These situations look identical to failing businesses from outside, but they're not failures. They're lifestyle choices that happen to look like storefronts. The owner isn't desperate for profit. They're desperate for purpose, community, or creative outlet. They're willing to subsidize meaning with money from elsewhere. And then, yes, a tiny percentage actually are suspicious. But not in the way people think. Modern financial crime doesn't look like empty pizza shops. It looks like busy vape stores selling thousands of disposable products with no paper trail. It looks like ATM businesses processing cash for dozens of other stores. It looks like car washes with unlimited monthly plans where usage is hard to verify. It looks like online businesses with no physical inventory where revenue inflates easily. The empty storefront theory is backwards. Criminals want to look successful, not suspicious. Here's why this matters to you personally. When you assume every empty storefront is criminal, you create real problems. You make people suspicious of immigrant-owned businesses that operate differently than chains. You make people report legitimate businesses to authorities and waste investigative resources. You make landlords nervous about renting to cash-heavy industries. That pushes those businesses out of neighborhoods that need them. And it distracts from actual financial crime, which is way more sophisticated than a dusty mattress store. Your assumptions have consequences beyond your car window. The reality is, most businesses you think are suspicious are just operating in ways you don't see. They have B2B clients. They own their real estate. They have low overhead. They have side income. They have old leases. They have patient owners. They have seasonal spikes you don't witness. They have online revenue. They have contract work. None of that shows up when you drive past at 2 p.m. on Tuesday. The entire business model exists outside your field of vision. You're judging a book by watching someone read the cover through a window. So to recap, empty storefronts survive because customer traffic doesn't equal profitability. Cash-intensive businesses serve wholesale clients, own their buildings, or have income streams invisible from the street. Money laundering through fake retail transactions is extremely difficult now because of reporting laws and pattern detection. The businesses that actually get caught don't look empty. They look too successful. And assuming every quiet shop is criminal creates more problems than it solves. So here's the real question. Does that empty store you pass every day make you curious about how different business models work? Or does it just make you assume the worst about people trying to make a living?